Okay, so this is chapter 14, and we're going to take a look at investments and all the different types that are available. We'll look at mutual funds, real estate, and other choices of investments. So the first one is a mutual fund. And a mutual fund is less risky than, let's say, something like the stock market because it is more diverse and far more liquid. So what happens is you go and find a mutual fund. It could be something like Vanguard, which is a company that does mutual funds, and they invest money, but a pool of people come in and they bring in their money and they invest shares in the mutual fund, and then the mutual fund managers go out and buy lots of different stocks. They buy bonds and they buy securities. So it's very diverse in the types of things that they go out and they buy. And it depends on the types of things they're going to buy. Like there's different types of mutual funds that focus in on certain things. But ultimately, what's happening is you're getting the opportunity to invest money into a very diverse portfolio of things that don't just include stocks, but also bonds and other types of securities. So the advantage of this is that you don't have to figure out what stocks to buy and which ones to not buy and when to sell and when not to sell. Those those ideas are handled by a professional. It's also far more liquid than a stock would be, or other types of investments. So you can go and get your money out. It's diversified by nature because you're going out and the person's buying lots of different things. And you can get in at a very low cost. You can go in for $1,000. So there's different types of mutual funds that are available. They're all built on this risk and return idea. So the higher the risk, the more money that you're going to get, where the potential is that you're potentially going to get more, but you could also lose a lot. The lower the risk, the less money that you're likely to get in the long term. So on the very high end of that risk is growth funds. And growth funds are companies that are trying to get bigger and bigger. So you won't get things like dividends, which is like when a company does well in a stock and they give some of the profit back to the investors, because that money is going to be put back into the company to grow it, to make it even bigger. An income fund is different than a growth fund in that it's a fund where you're going to invest in stocks. They're going to give you money as you go along, even if you don't liquidate. So you'll get interests and dividends, and that you could put back into the fund. So that's a little less risky, and a little more likely to definitely get some money, but not as much money. And then there's some to try to balance the two. So they have a little bit of growth and a little bit of income. That's really what it is. And a money market is a fund that is mostly in really safer things. So that's like in the bottom of that pyramid. And they are investments in liquid security, such as like a treasury bill from the US government or bonds that might get issued, and they don't mature in less than a year. So they're they're um, they're just a little bit safer. The return on those things are not going to be as high. But if you're investing in a government like the United States, for example, it's a sure thing. You're going to get money out of it. They're going to pay their interest. So you typically, if you're a little safer, you might want to go for a money market. So that kind of shows you the risk and return pyramid at play. Global funds and index funds. So a global fund is a mutual fund that purchases international stocks. So not just ones in the United States, but also around the world. And of course, international bonds as well as US securities. So you could have a global fund that's a growth fund, or you can have a global fund. It's an income fund, but it's a type of fund. Like where's the money? Where are like these stocks or bonds coming from? And then finally, index funds are a fund that is like looking at all the stocks that are in the S&P 500 that they index together, or the Dow Jones. This is another one. It's like a series of stocks that they have put together, and they are just going to match that. So you're buying whatever is happening in the S&P Savings Standard and Poor's, or the Dow Jones Industrial Average. So it depends, what you're looking for. But the index fund is just matching or mimicking what those funds are. That's what that one is. So when you're looking at how much you actually are going to get in the fund, you can do this by looking at the net asset value, tells the market price for a share of a mutual fund. So when you go out and buy a mutual fund, you're going to have a share of the profits. And the net asset value, or the NAV, is the total value of a fund's investment portfolio minus all of its liabilities, and you divide that by the number of outstanding shares that are not shares that are available. Another type of way that you can invest is real estate. Now, real estate is a little different, and I think the biggest difference is largely liquidity. And so that's when you invest in real estate. You're buying the land and the buildings and the improvements that are done on it. The advantage of this is that it's a good way to combat inflation, because usually the home increases value over the years at a rate equal to or higher than inflation. So usually if inflation is going up, you can even do better. The biggest disadvantage, of course, is that real estate investment is less liquid than stocks or mutual funds. So it could take you time. You could put your house on the market and it could sell really quick, or in another moment it could take half a year, it could take a year. We just don't know for sure how liquid that is. So it's not something you just get rid of one day and then not have that as an asset anymore and have all the money. It takes time to sell something like real estate. And some real estates are speculative, like someone buys a house in Florida because they think that the investment, like it's going to be a good investment, but it doesn't always work out in the end, where something could happen outside of your control. And that's true for anything, but it also is true for real estate market investing. So buying real estate, with direct investments, the investor can actually own the property itself. So they would own what they call the title, which is the right to actually own that piece of property. So what are some examples? You can buy some land and then decide that you're going to sell it. Or you could buy some land and you could improve it in some way. You could put in a business. You could put in a house. You could go and buy a home, single family homes, meaning like no one else is going to live in it but that one family, and it's not attached to some other building. A rental property, you could buy the home and then or the apartment or the condo, whatever it happens to be, and then rent it out to people. Or you could buy the property for the purpose of your own recreation, like you want to go down to Florida once a year, or you want to have a retirement property where you're going to live there for 6 months, and when it's really hot, you go somewhere else that's a little bit cooler, and you kind of swap places. It becomes like a second home of some kind. So, other types of investments, and these are often like considered speculative. Like you don't really know if these things are going to go up as much as other things, but you still do it. Now, most people who have things like this are doing it because they get some sort of personal joy out of it, but not necessarily thinking that it's the best investment. It can do well, depending on the moment. Sometimes the market won't bear what you thought it was going to when you went to go sell it. But most people are doing things like precious metals that are valuable around the world, or gems. That would be like things like rubies, sapphires, diamonds, and emeralds. Or you can have collectibles, so things that are rare, like antique furniture, or a famous piece of art, or baseball cards, or stamps and comic books. They're all called collectibles, things that people collect, and that there's a group of people that are interested in it. But it's not that everyone is interested in that baseball card, because not everyone's interested in baseball or sees value in it or in stamps. But there's some buyers out there that are very much looking to buy these things. So collectibles can do well, but they're definitely not liquid. So I would think twice before you get too involved in things like this. All right, so there's 3 types of investments that we went over: mutual funds, real estate, and then these other choices that you can have. So thank you very much. Be wise with your investments.